Zoom.
Shall we start, Fred?
Yep, we're
And
going right now. The
remind you, hit
20,
recording.
yep, the 2026 I-29 New University Dairy webinar series continues today with Ron Mortensen from Dairy Gross Margins discussing information about the new USDA RMA livestock insurance programs that covers dairy cull cows and 2-week-old drop calves. He will be joined by Curtis Bosma with High Ground Dairy in the discussion of LRP cull cows and drop calves. Together, they will include examples of how to incorporate these products into your operation. The I-29 New University is a consortium of extension dairy specialists from the land-grant universities of Iowa, Minnesota, Nebraska, and South Dakota. The I-29 New University is a multi-state learning collaboration and connects extension dairy staff with the dairy community to share research, information, and management practices through workshops, webinars, e-newsletters, podcasts, and on-farm tours. To review the archived webinars and podcasts, or for more information about the I-29 New University collaboration and its programs, visit i29muu.com. Our presenter today is Ron Mortensen. He was raised on a farm in Northwest Iowa, earned a degree at Iowa State University in agriculture education, plus an MBA, attending evening programs at Drake University. His career included 8 years as a banker in Webster City, Iowa, and 3 years at a large bank in Chicago. In 1985, with the start of Ag Options at the CBOT, he started a farmer-oriented marketing consulting company. Ron and his wife spent 40 years helping farmers manage risk before selling the business in late 2024. In 2006, Ron started a crop insurance agency helping farmers with the RMA USDA insurance products. Also in 2006, he started an agency helping livestock farmers use the newly created LGM, LRP, and later DRP products. Ron has sold the livestock policies for cattle, swine, and dairy. Currently, the agency has clients in multiple states with a concentration serving California dairies. Ron and his wife also farm in 3 locations in Iowa. As I always say, gentlemen, the podium is yours.
Thank you, Fred. It's great. This is a timely discussion. In fact, on Friday and even Saturday morning, I was still getting new updates to this program. And so we'll go through what I think we've learned and what's going to be happening. And I see Curtis has joined us, and Curtis is my new best friend who's done drop calves more than I've done, mostly cull cows. He's done more crop drop calves. So we'll hopefully his experience and everything else will help explain some of these new products as we down the road. But literally, Friday and Saturday, we were getting updates on these programs. So this is an LRP dairy program that manages price risk only. It's not a mortality program. It's USDA RMA backed and is very similar to those of you who use crop insurance programs. Premiums are due at the end of the coverage. It is now subsidized, and there are no transaction fees or transaction costs from the producer standpoint. The government pays those fees. This program has evolved actually out of the Iowa State University. Hayes and Babcock and Hart started the LGM process, and then Maren Bozic took over the LRP and has added programs to this and actually really ramped up all of the new products. LGM is improving. And so what we started with was a pilot program, and now we have a full-blown program in multiple states and lots of coverage, lots of transactions going on. So this is very similar to buying a livestock put. And what we're going to be talking about first is the Cull cow. Dr. Bozick says it's a 94% correlation to the feeder cattle market. It was, I gotta be honest with you, it took me a couple of months to kind of get my head around that. I thought it would have been fat cattle, but it is feeder cattle. And here is his presentation of why it does correlate. Excuse me. The subsidy levels, as you can see here, 100% coverage level is at 35%. It does change at the 92% coverage level to 40%. So, excuse me, I always think that the sweet spots here from 40% or 92% up to 100, the odds of getting paid are a lot less as you go down the road here. So, excuse me. LGM dairy will be available daily except for report dates and holidays, which we just came through both of those. And in addition to that, if there's a limit up or limit down move. So on Thursday, we had a limit down move in the feeder cattle. We had no LRP. On Friday, we had a crop report. And on Monday, we had a holiday. So we've seen all three of those days. So actually, the data we get is kind of old, but it's the newest. It's available. The Cull cow is actually a 13-week coverage level. Starting on July 1st, it'll go to up to 52 weeks, which is one of the first new improvements. And the good part is you can have, as long as you own the cows on either side of that ending date, you should be in good shape as far as claims. You will probably need to have it. You will need to have a proof of loss. Sales receipts, probably the most common. And then there's another definition, but the easy answer here is these cows are intended to go to slaughter. There's really no proof of this, but the sideline story is they shouldn't be pregnant, probably is the easy answer here. So this product is available to the next morning at 8:25 a.m. There's no bids and offers. I mean, it just happens. So if you go to the CME exchange, there'll be a price, and one will be a bid and one will be offer, depending on whether you're buying or selling. But this just happens, and it's very efficient on how it happens. There's no volume issues here. There would be a 25,000 head cap on any of these LRP products as we go down the road. There's no income restrictions like a lot of the FSA program products have. And then the only big hurdle, which is not big an issue, is you need to have an AD 1026 or be conservation compliant. If you have crop insurance, you've already done that in place. Cull cows, this is the definition: removed from the herd and marketed for slaughter as beef, whether sold direct for slaughter or placed on feed prior to slaughter and expected to grade USDA standard or lower. And before this definition came out, we had another definition said that they should not be pregnant. We were having some issues with a couple of people to make sure that these cattle were slaughtered, but you notice that it says expected to be slaughtered and expected the standard grade. So I think we're through some of those hurdles. We're doing now 13 weeks. Starting on July 1st, we'll go to 52 weeks. The weights are 800 to 1,700 pounds, and I think it goes to 1,800 pounds starting in July. These are the factors. Maybe I should go back here. No, these are the factors that he uses to plus it up from the feeder cattle CME index. And you can see that there's every month's a little bit different. I'm going to say 90% to 73%, it looks like, is the range. The traditional would be 50%. Excuse me, 50. It's 50% basically on the far right side is what we're looking for. Um, so if you see the CME, you're looking at a 45% up to a 50% range of the value of that. It's pretty easy math. It's the two futures contracts on either side of where you're at. Obviously, the closer you're to the one, the left or the right, whichever is going to be more heavily influenced. It is a black box. We don't get to see that. So it's the feeder cattle prices times the factor, and that's the beginning value, and the ending value is the same math based on the two futures contracts. And then you will need proof of production or a settlement sheet at the end. These tools have become very good for long-term planning. And now that we can go 52 weeks, it'll be very helpful. And as Fred and other people tell me, Curtis tells me, it's become a big deal that the beef side of this business has become very important for everybody. It will reduce your volatility over a stream of years or months or days or whatever you want to say. But we've done this in the crop side of it for many, many years, and it does reduce volatility. It does give some sense of cash flow guarantees. And it does integrate with other marketing programs. You can still do CME transactions and cash forward contracts if you'd like. This is a chart to keep track of the cull cows. And I mean, we did obviously peak out a couple times, it looks like, just recently in April and then also back in January. The bottom two lines, the top two lines are the 100% coverage. The yellow line is 92.5% coverage level. And then the blue and the gray line below that are the premiums. And we run anywhere from 50, say it's in the 75, 80, $75 range right now. The 92.5% coverage level, we're in the 15s and they're running $18 per head now. So it's not very expensive. We have people on a program that every 2 weeks they'll do so many head of cattle. They just keep doing it, putting it on. It's kind of a good news, bad news. There have been no claims because the feeder prices have stayed up here so far. I guess the good news is there's no claims because the rest of the herd is worth a lot of money too. So this is
Ron,
just
not sure if you saw there's in the chapter, you could go back to page 1 to show the premium again.
right
Is
here,
that possible?
right here,
He says page 1.
way back here.
Yeah, I'm not sure exactly which one.
Yeah, it was quite a ways back,
uh,
Ron.
the premiums.
Yeah, when you've had them on the chart, there you go.
Uh, this one right here.
Roger is at,
The
The very
premium one.
beginning. Very beginning.
That's the first slide right here.
there
There
we
you
go.
go.
Yeah.
Right
Okay,
there.
that's the premium subsidy levels. I'm sorry. So if you're
Thank
doing
you.
a 100% coverage level, you got 35% subsidy levels. If you do the 92.5, it's 40% subsidy. Is that what you're looking for, Roger?
Yes, thank you very much.
Okay, yeah. Um, there and Curtis can tell you later on. Maybe he's done maybe more of them up in here. We've been kind of picking on this number because of the 40%. If you do this, obviously the odds of getting paid are a lot greater. And we haven't had that scenario yet, but someday it'll happen that you're going to want to be closer to the hundreds percent coverage levels. Okay. So that's the chart. And there are days where the values go up and the premiums go down, which seems odd, but it's a volatility driven product. So based on what the volatility of the CME feeder cattle contracts are, will drive what those premiums are being happen. This is just a closer shot of the last few months. You can see that it does track. I mean, I track it every day, and it's pretty interesting to see what's going on. So here's kind of an honest to God quote, and here's 100% coverage, 35% level. Here's that value in here, which is factored to the CME. And then over here, here's the premiums, $62 a head from the producer's side. And then if we go down into the, 1820 is what is per head on this one right here. Just as a side note, these are the strike prices we're correlating with to kind of give you some idea. If you were going to do it at the CME, 120 down to 90, 94, that seems high, but it does give you a sense that there is a pretty big discount in these deals. So $18 a head, and then it guarantees this price, this 169.19 times the weight. And the weight, I've been using 1,400 pound weights. And so let's just make sure I got the right one here. So this is for 10 heads. So one head would be $2,368 per head is what that guarantee is. Up here is $2,500, $2,561 basically per head guarantee. And if those values get calculated below those levels at the end, then this one would be in 13 weeks out. So it's August 18th. So that's what we're talking about. That's just the closer up. So coming in July 1st of this year, there's a couple of programs. Doesn't impact the Cull cows, but it may impact the other LRP products. The LRP for feeder cattle was based on the feeder cattle index, and then on the CME, the fat cattle was on the CME on the fat cattle side, and also the AMS. So it's got more of a cash flavor to the to the fat cattle program. Marn's made some adjustments to that, so it'll be more correlated as the beginning and ending values. Like I said, probably not a big deal. Here's one, the LRP feeder cattle, prominently dairy with new adjustment factors. So if you don't do the Cull cows, and the next product we talk about, you don't do the drop calves, you now, starting in July, can do, the 2-week-old older up to 600 pounds, and there'll be a dynamic factor in there. It used to be 50%. That's all they would give you. Now it'll be these ranges, 125 to 141. If you do a 600 to 900 pound animal, it'll be 75 to 81. And here's kind of what they're talking about. Here's the weight one class, 100 pounds to 600 pounds, and here's the 600 and 900 pounds. So you'll be able to go out and do those products out here and have a better factor than we were doing before, 130 to 175, because otherwise it was 50%. Also coming 27, which is another year away. 4 days ago, I would have told you the ELCO was going to 50-60% chance of happening. As of Friday, Saturday, the new comments were the RMA is actually having difficulty trying to justify the cost structure of this. So it might be the 27, 28 farther out. Basically, this product is like an ECO product that you might have used on your corn and soybeans. It would give you up to 80% subsidy level from the top 80 or up to 95 level areas. And instead of having a milk per cow factor in here on the DRP, it would give you a national milk per cow. So that one's probably a ways off and maybe a dream here. We'll have to see. But the next one here says next year, July 1 of 27, unborn calves and the drop calves, which we're going to be talking about in a second. We hope to get dairy on dairy. Right now, it's dairy on beef. So anyway, I'm going to switch gears here and kind of go through a couple of things, and then we'll see if Curtis has any comments. So this is the unborn calves, 99 pounds or 2 weeks old. And basically they have to be sold. I mean, you can't keep them, but you have to eventually have to have a receipt for the sale of these. It's the same subsidy levels, Roger, you were talking about here, 35 down to the 40. This is the standard for the LRP programs. So it's the same thing, no report days, no holidays, and no days that are limit up or limit down. So the changes are that these are, well, this is standard now, 13 weeks to 43-week coverage levels. So you can go quite a ways out and do that. We've had a couple guys do this. I think Curtis will talk about this maybe a little bit. There are more people doing it, depending on if they have the ability to do these things. You'll need a proof of receipt, a sales receipt. You cannot sell these cattle to yourself, I guess, is the answer. Okay. But here's probably the real issue for some people, but not everybody. It is similar to buying a put, but these cattle need to be 50% beef. It has to be a cow, a Holstein cow, and a semen from a beef animal. So today and for at least another year, that's the kind of program that this will be with. So you can't do dairy on dairy and with this program yet. Same kind of a program. There's a beginning value and then there's an ending value. We'll need to be proof of production. Typically settles a settlement sheet from the buyer is what you need to have. This program is 99 pounds or less. And what we call them 2-week-old drop calves, I guess is what we want to call them. The newer program that'll be available will be the one weights, which is 1 pound to 600 pounds. And here's the dynamic factor that we talked about again. And the 2-week weight range, 600 to 900 pounds. And they will still need to be 50% beef. As I'm waiting for Curtis to nod his head. Yeah, I think that's right. Yeah. So here's my chart of the unborn calves. I don't have the premiums on here. I just have the raw data. And it's the 92.5% and the 100%. So we did peak out in the feeder cattle market up in here. And we've drifted lower, but we've had a little bounce here lately. So you can kind of see at a nice little peak here. And it does track very well. So here's the 13-week one. Here's the one that's 17 weeks, and we had a little higher spike back in here. And sometimes that little factor in there will maybe push that up a little bit too over time. But so here is the quoting sheet for this. 100% level, 14, 100 a pound, basically 100 pound, 99 pounds. Expires on 8/19. If you do 100%, premium's $34. If you do the 92%, it's $10. So that's kind of the range. Yeah, this is just a little bit bigger picture if you want to see that.
And Ron, is the premium, is this for beef much different than dairy?
Say that again.
Is it much different for beef versus dairy, or is it the same program?
You can't do the beef. It has to be the dairy.
Okay.
So it has to be 50% beef, and beef. It has to be beef on dairy or dairy on beef, whatever. Have 50% beef. So next year, which I would assume if that program becomes available, then if you have 100% Holsteins, you'll be able to do this same product. Um, who knows? The premium should be the same, I would guess. That it would make sense it would be the same. So, but it does go out here to the 43 week, and so then we're talking about $60 a head, and the 92% is $37 a head. So a time value of money, but that would give you coverage all the way out to March of 17. Okay. So that's my contact. That's our California contact. And then here's Curtis's contact. And so I don't know, can Curtis get access to
Yep.
the speaker?
If
Yeah, you guys hear me all right?
Yep,
Yep,
I can
sure
hear you.
can.
Go ahead. So any thought processes here, Curtis? Did I miss something? What kind of experience have you had with the unborn calves probably is the question.
Yeah, I was going to share my screen here real quick if I could.
Yep.
Um,
Ron, you will have to unshare or quit
Oh,
sharing.
stop
Yeah.
sharing. Okay.
Yep.
I'm giving him control.
all right. You guys see this okay?
Yep.
So I think, I mean, in all this stuff, it's great, but I'd like to kind of take a step back and, why is this important in terms of managing a dairy? We publish what we call our weekly margin monitor here, where we're basically modeling a typical dairy farm and just saying, okay, we're going to have, this much milk production. Here's, we're taking national average for milk composition. We're looking at it in terms of feed usage of what we can do, and then also kind of taking a look at all the publicly available data in terms of operating costs to be like, okay, how can we model around the ebbs and flows of a, dairy's profitability going forwards and backwards. So we kind of break it into these quarterly margin buckets where we can look at stuff. As you can see, we've had, a pretty prolonged run here of positive, economics things on the dairy, but we had milk prices kind of soften going into 2026, which was changing the dynamics, but margins stayed healthy because of how significant this beef revenue is. So if we look at like this is
Curtis, can you hear me? Is that green because of the beef, or is that just the year?
Yeah, so beef is a big portion of it. So if we look at kind of the four elements of what we're modeling for, like this, and this is just isolated to the third quarter of 2026, the milk revenue we do, it's like 55% class 3, 45% class 4, which is roughly the national average. We're using a 4.2 butterfat and a 3.3 protein, which is kind of national average as well. And that's what gets us to our milk revenue number. Our beef revenue is assuming based on roughly about 1,000 milk cows, every dairy can produce about 50 head of drop calves that would be sold at day old, and about 27 cull cows per month as well. So we're kind of modeling that into the beef revenue side of things. And you can see here, if we kind of, standardize that back to a per hundredweight of milk, beef revenues, almost $5 a hundredweight. I think in some cases, it could even be greater than that, depending on, current herd dynamics. Obviously, replacement heifers being as expensive as they are, that's kind of been the counterbalance to all of this. But overall, that's that's why this stuff is important, because if you look at the overall margin with feed costs around $12 a hundredweight and operating costs we're assuming around $9 a hundredweight, well, you're kind of trading your milk for your feed with a little bit of the operating costs in there as well. But the margin side of it's been driven off of this beef revenue, and that shouldn't be a surprise to any dairy producer out there that's been tracking their budgets the last 12 months, that beef has been the real driver. But it's really interesting just to look at the numbers and look at how significant that is in terms of the overall on-farm margin of what it is. And that's where, like, historically, when we were kind of modeling for dairy farms profitability, we always kind of knew like, oh yeah, there's revenue items that are non-milk, but they'll never exceed a dollar a hundredweight or $1.50 a hundredweight. But then as we started looking into this, when beef prices started climbing, a year or two ago, that fixed assumption of non-milk revenue became very irrelevant and inaccurate. So kind of went back to the drawing board, updated our model here. But yeah, as you can tell, it's quite significant in terms of how much that contributes to the overall equation that we're trying to solve for. And again, like this is where, when talking about risk management, obviously milk is still going to be the lion's share of the revenue on the dairy farm, but protecting this beef revenue, because that's where the margin is, has become increasingly important here as of late. So it's nice that we have tools like LRP to be able to tap into this stuff, as a pretty easy entry point where you have subsidized premiums that are not due until after the coverage expires and things like that.
So would you roll it up, the top graph? What's the green? Is it something that green in there? Is that the beef side of it, or is that just?
So the green side is everything that's pending going forward. So it's a remainder
Okay.
of 2026 as well as 2027. And we
Okay, I
send
see
this out
that.
every week, and we can show kind of the change versus the prior week. But you could see, like, the second half of 2024 had amazing margins for dairy producers. So maybe we're not quite at those levels, but it's pretty rare in this business that we see, 2-3 years of extended profitability. Typically the dairy industry, unfortunately, can be quite, feast or famine, and have a lot of volatility year in and year out. So it is providing us a nice opportunity through all these alternative revenue sources. And then I've got a sheet I can kind of walk through. I know probably the question everybody always has with this stuff is, this is great. I understand the importance of it, but how much does this stuff actually cost? And realistically, how much money am I going to have to spend to actually participate in something like this? So I've got kind of a real simple quoter that we've put together to kind of help people play with a little bit. And we're kind of just assuming here on the unborn calves, we picked the targeted weight of 99 pounds in a lot of cases, because as long as it falls in that 60 to 99 pound category, it fits within the class. So by declaring more weight, we can get away with potentially declaring less head. Coverage is on a per head basis. So we want to make sure that we're maximizing the amount of weight per head of cattle that we are declaring. And then, as Ron had talked, coverage goes out, 13 weeks out to 43 weeks, to call it 3 to 9 months out into the future. I always like to look at this across the entire span of time. If you have 100 head per month across this time span, that you're basically going to be selling between August of this year and March of next year, you've got the opportunity right now on those 100 head to secure, almost 1.2 million in revenue there for about $43,000. I think, and that's at the 100% coverage level. This is just all in on a per head basis. We're looking at these trigger prices and premiums and stuff that are there. And the way I like to think about this too is, like, this beef revenue in terms of the dollars invested in it that producers have. If you're selling about day old, it's not like there's a significant investment in the animal, once they hit the ground. So it's a very nice cash flow in that sense, with relatively limited risk operationally tied to those animals. But when you look at this and you're trying to be like, okay, I'm not spending the money now and I'm getting these really good returns. Is it really worth it to me? Well, you look at the producer premium against the trigger price, or what you're covering. It's basically called 2 to 4% of the value of the animal that you're selling. So basically, if you're okay living on 98% or 96% of your current calf revenue, to secure a price floor at current market levels, then it becomes a much easier equation to be like, okay, yeah, if we can secure that going out 9 months, that's a pretty good deal for my operation. When I look at the budget, $4 to $5 a hundredweight of that, beef revenue that I kind of need to keep coming in. This helps really kind of solidify that on the sheet going forward. And on the
So,
cull cows here in the bottom, I just have the variable weights. Obviously, we don't have quotes yet. We will be able to, come July, quote this out across the calendar and kind of have a similar discussion. But yeah, prices on that works out the same roughly.
So Curtis, up your top scorecard there, if you put a one hit in there, you'd be $400 a year, and you'd be $100,000 in guaranteed revenue. Is that what that says? There we go. Yeah,
Let's see. Yeah.
$11,000 for $400 in annual premium.
Mhm.
And you're using the 100% coverage levels.
Correct. That's at the 100% coverage level. There's, you know, lower coverage levels available. Um, we want to increase our odds of being able to get paid out on this stuff. And like I said, even at the 100% coverage level, it's basically no deductible insurance because you're getting at the market coverage on this stuff. Um, and if you're okay with, you know, paying the premium of, yeah, like I said, 2 to 4% of the cost or the value of those animals per head to set that price floor, then you might as well maximize your odds of getting a potential payout on that coverage. Any specific questions from anyone? I know we kind of ran through a lot of these
Right.
numbers.
Yeah. So Fred, do you want to ask people questions, or how do you go from here? Go ahead, Fred.
Well, I would encourage our listeners, if you have a question, we're a small group, go ahead and just unmute and ask the question directly, or you can type it into the chat box either way, and we'll catch it and ask the question that way.
I'm sure
Um,
Larry will ask a question, won't he?
Usually does. I'm going to
I, re-
start.
I already asked mine.
I'm
Okay.
go I'm going to start with the question when you were talking about drop calves can't be covered if you maintain ownership. However, is that necessarily true if my dairy sells these calves to my feedlot? I mean, we see that a lot in our larger herds where the guys are feeding out steers.
Um, I'll give you my answer. Let's see what Curtis says. I think if you're going to do that, I would probably have a discussion with the RMA. We'd ask them whether this is legit. Okay. We know that this was going to be a question down the road, but I wouldn't want somebody to pay the premium and expect to get coverage level, and then all of a sudden RMA says, you're really selling it to yourself. So we want approval before we did it. So Curtis, you have any thoughts?
Yeah, I mean, it's more so, you know, an entity structure question, even more so than a legality question, I believe. Because if, you know, if your feedlot has a different ownership structure and is a, you know, entirely separate entity, well, then maybe. But if it's the same ownership structure, then I would kind of ask the question, do you need to cover the sale price of the calves? Because if you're retaining ownership, if it's through another entity, your true risk is on the final sale you're making when marketing those animals at whatever weight you're taking them to. That would be more important financially and economically for the underlying business than, you know, the cost or value that you deem the transfer from one entity to the other. So I hope that kind of makes sense. But yeah, that's kind of how I would think about it.
Yep.
So Curtis and the group, I would say, Fred, that because of the new program starting in July, you'll be able to go out to the 600 weights or the 900 weights and get the LRP coverage there. That's where you probably should go and do the coverage and just jump all the way out to that. Does that make sense, Curtis? Do you think?
Yeah, that's where you have far more risk. I mean, if you're retaining ownership of your day old crosses and they're going into a feedlot operation and you're feeding them for, you know, call it 165 days, taking them to, you know, 450 pounds or something like that, and then selling them to another party, well, your risk is far greater on that sale price, you know, 165 days out on those animals. That the, you know, value at a day old doesn't really matter to you that much because you're passing it from one to the next.
Does that answer your question, Fred?
Absolutely. Absolutely.
Okay.
When you were talking about the cull cows that you had a top and bottom weight, I've seen a bunch of cull cows at 1950, knocking on that 2000 pound. What happens if they're outside that 1800 range?
Well, let me answer. I think it goes to 1,800 pounds starting
Yep.
in July. Is that right, Curtis?
Yeah, they're extending the weights higher.
Yeah.
And if you sell animals that are end up being heavier than the weight class that you've declared on your insurance coverage, that's totally okay. They just want to make sure that you get into trouble if it's under the weight class for some reason. But if you declared, 1,400 pounds and you sell them at 2,000 pounds on an average because you got some big bull cows, well, that's great. You're still only going to get the coverage eligible for what you've declared, but there's no issue to the underlying coverage.
How are the lenders responding to these products? How do you see them fitting into this system?
I mean, a lot of lenders are even starting to offer this directly. If you're within the farm credit system, they have these types of programs that they're offering to, um, producers to be able to utilize. I mean, I think they're just kind of limited to insurance only. They're not touching anything in the financial derivative space or anything like that. But yeah, I think it's becoming something that your lender wants to see that you're engaging in some form of risk management. And because these tools have become, much more accessible in terms of the capital requirements and just the ease of, being able to set up a policy to purchase coverage on these things and being able to execute a good amount of coverage against your future revenues has become easier and easier with the, introduction of these tools. And they're not perfect tools, but they're working to make these better and better. And I would say, lenders are definitely looking more favorably at clients that are consistently engaging in these types of things. Yeah, I think in all this stuff, and we always say risk management, it's not a one-time tactical management decision. This is a strategic choice to, if you're going to run your business and be proactive financially, this is something you do and you do it consistently and proactively.
So Fred, I'll put my banker hat on for this one. Is that okay?
Absolutely.
So to me, the bankers typically don't like to push the button and say, you got to do this, but they may encourage it. And to me, and I know Curtis is talking about doing the 100% level, but if you just did the 92.5, which is 40% subsidized, and you did that, the government's paying for 40% of this. It's like a no-brainer. Why wouldn't you do it to cover your beef side of your business? Because that's where you're making your money today. Is that Curtis is just telling us that's where the money's at. And if that goes away, these dairies are not profitable. Is that right, Curtis?
Yeah, I mean, there may be some efficient operators out there that can still maintain profitability. But I would say by and large, as an industry, if beef revenues were to drastically decline, that's kind of the only thing keeping cash flows intact at the moment.
Right.
And let's be honest, that's what lenders are all about, is cash flow.
Yeah.
So
Is that where you want me to step in, Fred, when you mentioned the word cash flow?
absolutely. I was keying you up.
So because I definitely agree that it's kind of a cash flow issue or whatever. So I wanted to kind of get Ron and Curtis's perspective as well. So yeah, if I'm a lender, it's kind of a cash flow thing. The tighter my cash flow, the more I'm going to have the impetus to work with these products because I can't have a negative cash flow at the end of the year or the end of 2 years. But I'm kind of wondering, a lot of the naysayers of these programs, and even though they're paying 40% of the premium, whatever, just when you take a look at the difference between cash flow and their long-term profitability, if I don't do anything for the next 5 years, how am I going to be different than somebody that tried to work with this every year for the costs that I've still put into it? Am I going to, if I didn't do anything, I'm going to get my money back out if I did do something? So I'm just kind of teeing up for one of you to take a swing at it.
Yeah, I would say in any business, there's kind of three levels of decisions that have to get made. So there's like operational decisions, which are basically protocols that, managers establish and say, hey, here's kind of how we do things around here. Those are very just systematic types of things. Then you get to your more tactical things where, you're influencing a couple of variables with the intention of getting to a specific outcome. I think, a lot of the stuff that dairy producers do on a day-to-day basis is in that tactical category of they understand the, biology and the economics of their business to know that they can influence a couple of things to be able to achieve a better return or get, more milk out of cows or whatever it may be that you're trying to get after. But I think this risk management stuff really falls into that strategic category meaning that there is a lot of variables that can influence it, but there's also a lot of outcomes. So it's difficult to point at risk management and say you're going to have a return on investment of X. Like there is no way we can mathematically calculate that. But when you look over the long period of history, people that have been consistently doing this and being proactive and staying in front of it tend to have, the rock solid balance sheets where, they're securing these margins. When things get tough, they are the ones that are not in a bad position from a cash flow perspective. And there's significant advantages to being in the driver's seat when you have, a bad economic time. Like right now, the dairy industry is going through a longer period of good economics, but when things are tight, and we had, some of those periods in previous market cycles where margins are tight, that's when people that are wanting to expand and grow typically have the greatest opportunities because, when you're the only one that has, strong financials when everyone else is kind of struggling, that's when you can typically kind of step on the gas and make sure that your operation kind of keeps moving towards, what you want it to be.
So Larry, I'll take a couple extreme cases. If you're borrowing no money, you'd say, why would I do this? Right. And that's one side. And if you borrow
Yep.
money, why wouldn't you do this? I mean, it takes the valleys and the peaks, takes out the valleys out of this whole program. And even if from a lender standpoint, even if you did 70% of your production under these programs, and you do the math that Curtis is going to show you, you're going to end up being over a 10-year period, you're going to be the winner because of the subsidies, because of just consistently doing stuff like that. The guy that's not borrowing the money, what he should be thinking about is making sure he gets his money back so he doesn't have to borrow the money. Okay. and tactically, I think Curtis is right. And we've seen this in the grain industry. The guys that just keep doing these management strategies and keep doing them, and then all of a sudden, if there's a really bad times, the neighbor's in trouble or the neighbor down the road's in trouble, and say, well, I'll buy that farm or I'll buy that equipment. It creates an opportunity that you don't have if you haven't done the thing tactically over a long period of time. So how's that for an answer?
I'd give you both an A+ on both of your answers, so I appreciate that. That's good.
Very good. For the folks who are on, if you have a question, go ahead and unmute and just ask the question. I'm going to talk to both these gentlemen and kind of see if we're going to get any questions. Curtis, a couple of your charts are pretty impressive. Who has access to your weekly charts? Are they available on High Ground website, or you got to buy a membership, or how does this work?
Anybody with an email, if you shoot us an email and say, hey, I want to get on this list, we'll get you on there. We send those out on a weekly basis, just kind of our margin monitor, and it's just kind of part of our standard subscription there. We do offer, like, if you go to our website, you'll notice we do offer like a premium subscription that if we get you on that list, we'll be sending you far too many emails. I know as dairy producers get too busy. We at High Ground, we service clients across the entire global dairy supply chain. So we have people that sit at desks all day that love to get 7 to 10 emails a day about different things in the dairy market. So we're happy to give them that for a fee. But I understand for the average, dairy producer, you don't want to see that many emails. So we have kind of our producer package where, we cover things like this margin monitor, and then we do, some other market updates and things like that. Makes it a little bit easier to get the meat and potatoes of what you're looking for. But yeah, anybody with an email can access that.
Very good. Larry, have you got another question or two? I'm not seeing any others come in.
Yeah, I don't think I do, Fred.
All right. Well, thank you. Go ahead.
Well, just that I would concur with a lot of the responses about just the need for the margin protection. And again, whether it's a cash flow or profitability issue, I think you can hit both sides of the coin for the needs of it. So I appreciated the answers both of them gave.
Right. Thank you, Ron and Curtis, for sharing this information and your insights on these risk management tools. This program has been recorded and will be available on the I-29 Moo University website. Give Brittany a couple of 3-4 days to get it up and running. I see she's on with us, and I always want to say thank you to her for making this program look as good as it does. At any rate, I will email you when it is available, as well as including the link to the program evaluation. I know everybody hates to do evaluations. This one's short, and it does give us a perspective on the things we're doing well and things we should change as we plan these next webinars out. Again, thank you for your participation, and I look forward to seeing you at the webinar next month. Ron, Curtis, thank you again.
Thank you very much.
Yep. Thank you.
I will now end this webinar.